Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and this week I'm going solo again to talk about finding good quality growth stocks here in 2022. Yes, growth, not value, but growth. So as we know, the S&P 500 is down just about 20% or so here in 2022, and the NASDAQ is down almost 30 now. A lot of growth stocks have sold off. We all know the story, but it's kind of the dog days of summer right now. I'm recording this in the end of June 2022, and everyone is kind of depressed about stocks and, not much is going on. The Fangman, those stocks are still lagging. Some of the Fangman stocks are even Zacks number 5 strong sells, which hasn't happened that often really in the past. Even one of the big cap global retailers, which was a big pandemic winner, is a Zacks number 5 strong sell right now too. That's Nike. And, they're having trouble in China there. That's their biggest issue, down 19% in the fourth quarter due to those COVID lockdowns. But I wanted to still look at the growth stocks because when you feel kind of depressed about it or, you think there's no deals out there, that is the time when there usually are. So can I find growth stocks with a high Zacks rank and maybe like double-digit earnings growth still going on out there? Is that even possible in this market? I didn't know because, again, I'm the value person, not really the growth. And I decided to run a couple screens to find out. So the Zacks.com website has a screening page, and it has those predefined screens I've talked about in the past. So I like to use those. You do have to be a Zacks Premium member to access those, but there's some really good screens on there. I didn't count how many screens total are on those predefined screens. I would say it's at least like 20 or 25 screens, maybe a little bit more actually. And there's good combinations on there, especially in the growth area. There are value screens. There's also momentum. You can screen by market cap and a few other screens that I've used many times on the podcast that I like a lot, like the hidden gems screen. But for today's, I did want to use some of the growth stock screens. So I kind of just wanted to get some of the best, right? Why not? If I'm looking for the best on the growth side, I might as well use the screen that's going to get them for me. So the first one I clicked on was called Top Ranked Growth Stocks on the Move. So presumably these are, something good is happening if they're on the move. It does include industry rank, and that had to be in the top 50%. Also number ones or number twos. So buys or strong buys. And the growth score, the Zacks style score for growth of A or B, those are the two top ones. So I ran that in there and I got one match. So I was a little concerned about doing this podcast after I did that screen and I only got one stock. I was like, maybe there really isn't enough growth stocks that have the good rank and some of these other good indicators that we have here at Zacks to find out there right now. Maybe that's why I am depressed, right? But the stock that did show up on this screen, just so you know, is PRDO Education. I'm not sure I'm saying that right. I'm always bad with the company names. Ticker, though, is P as in Paul, R, D as in David, O, PRDO. And what they are is primarily an online post-secondary education company. So they give out associate and bachelor degrees, like I said, primarily online, but they do have 4 on-the-ground campuses, one in Atlanta, one in Houston, and 2 in Colorado under the CTU name, which is the Colorado Technical University. So those of you in Colorado might have heard of this company and just not known that it's PRDO Education that's running it. What's going on with them? So they are in the top 50% of industry rank, top 39%. They're ranked 98th out of 251 because they're in the schools rank. They are number 2. Stock is actually cheap here, PE of just 8.4. What is the shares doing year to date? The shares are down just 0.09%. So kind of just flat for the year, but the NASDAQ is down 27.7% year to date. And over the last year, these shares are down 8.2%, NASDAQ down 21.3% over the last year. So it's got the good scores, but this is the only one, the only one that's in the top 39% of the industry rank, apparently, and has a number 1 or number 2 and the growth scores of A and B, because that's all that this one looked for. So keep that in mind, just one on this one. So I had to switch. I had to look at some of the other screens, right? So I decided to look for another one that is going to give me like some of the best growth stocks as well. And this one is a little more narrow. So it's called market beating growth stocks. Yeah, that's what I want, right? Market beating. This one is expected to have 20% or more projected earnings growth. So I'm going to like that, especially in this kind of environment. It's only a Zacks number 1 rank. That's why I said it's a little more narrow. So those are the strong buys. Remember, there's only about 220 or 230 of those number 1s at any given day. So that's a small group. And then it has to have the Zacks style score for growth of A, which is the top growth score. So this is pretty narrow. I was a little nervous clicking on the, run screen button on the site. And surprisingly, I did get 31 stocks. So I was surprised at this. So maybe it's the industry rank that is working against that other screen. There's not many growth stocks in industries that are in the top 50% of the industry rank. So that's kind of interesting, actually. So keep that in mind. What was in this 31 stocks? There was a lot of energy and auto retailers. We've talked about them extensively on both this podcast, the Zacks Market Edge, as well as the Value Investor podcast. I'm not going to cover any of those on this podcast because, again, we've already talked about them. But that 2 areas also has the strong earnings growth. It's got good Zacks ranks. And apparently it's also got the style score here for growth. So keep that in mind. Energy and auto retailers, also dirt cheap too. So those are like growth plus value. And that's kind of a rare combination. But I picked out just 4 other random names so that we'd have 5 stocks total for this podcast. And I kind of tried to find, different ones that we haven't talked about in a while to kind of see why are these growth? What is happening? What are the stocks doing? Are they cheap too? What's happening? So the first one I picked out was Airbnb. ABNB is the ticker. We all know them, right? Kind of surprised there's Zacks number 1, strong buy here. But that is because their earnings estimates are on the rise. So last year they lost 57 cents. This year, they're expected to make $1.82. So that's earnings growth of 419%. So that's how they're qualifying on the earnings growth component. But these shares have really sunk. Everybody who's following this knows what I'm talking about. So year to date, they're down 40.3%. They're near the 52-week low again. And that's, just pretty brutal. It's worse than the QQQs, which are down about 27%, I guess we were saying. So it is underperforming just the QQQs. But again, it's making this list because the analysts are raising those earnings estimates, and it does have the positive earnings now. So it does have a PE now, and that PE, though, is not cheap. It's at 55.7 times it's trading. So when I was looking at this, I'm like, okay, in this kind of market environment, it could be that these shares continue to sink because even for growth stocks, 55 times is just still too pricey for even growth investors to want to buy in. So they're looking to get it a lot cheaper is what I think. But again, I'm the value investor, so I'm not sure what the growth investors are all thinking, but they're still abandoning Airbnb here, even after the big slide and even after the estimates are on the rise. So keep that in mind with this one, Airbnb, ABNB. You might want to keep it on your watch list and kind of see where it goes. If it gets a lot cheaper, could be even more interesting. Okay, the second one is completely different industry. Sanderson Farms, SAFM. They are the third largest poultry producer in the US. They have a 4.9 billion market cap. And year to date, these shares are up 15.1%, year to date. Over the last year, up about 12%. So both of those numbers are outperforming the triple Qs here. Earnings expected to be up 137% this year. So they're supposed to make $48.02. They only made $20.25 last year. So quite a huge gain in the earnings. We only have one estimate and it is higher. So there's not a lot of analyst coverage on Sanderson Farms, believe it or not. But I'm kind of believing the analysts if they're giving out estimates like this, that's this kind of bullish here. They do pay dividend yielding 0.8% and PE just 4.5. So really cheap here, even though the shares are up this year because those earnings estimates continue to rise. But some of these could be the result of, pricing power. They're pushing up the price of the product here onto all the rest of us. We all know buying, chicken at the grocery store, what is happening with the price increases. So that's something that's in play. It's unclear if they're still going to have this pricing power into next year. But for now, 2022, Sanderson Farms has the growth. And so that's why they're making the list. Ticker SAFM. Then I went back to tech because why not? If a tech company is going to make this list, I want to check them out. So it's Cantaloupe, and their CTLP is the ticker. And for those not familiar, they are a small cap software and payments company. So I just went on their website and wanted to find out what it is they do. So they provide end-to-end technology solutions for the unattended retail market. And I was kind of confused at first when I read that. I'm like, what does that mean, the unattended retail market? I don't get it until I kept reading. And then they talk about how some of their customers are vending machine companies, gas and car charging stations, laundromats, kiosks, metered parking terminals, things like that, where obviously they're quote unquote unattended. There is no person there, taking the money. There's some kind of machine, computer thing, and they help with solutions for that. So a little bit different area, but also intriguing. So two estimates are higher for fiscal 2022 over the last 60 days. That's how they're getting the good rank. Earnings expected to be up 85% in fiscal 2022 and another 275% in fiscal 2023. However, earnings are negative right now. In fiscal 2022, there's no PE. They're expected to lose just 2 cents a share, however, and they lost 14 cents last year. So they're heading in the right direction. And fiscal 20, the analysts have positive earnings of 4 cents for 2023. So it's possible they may go into the positive earnings for next year. That would give them, at their current price, forward P of about 136 times. So still pretty pricey for Cantaloupe, even with that earnings growth. And year to date, these shares are down 38.8% over the last year, down 53.7%. They have been around a while, a number of years, so they're not one of those new recent IPOs. But over the last year, again, down over 50%. So could this be a buying opportunity in some of these types of growth names on the software side? A lot of people are looking at this industry because a lot of the bad news is already priced in, right? I'm not saying all of it is, but a lot of it is. So this might be one you might want to keep on your watch list as well. As I said, it is a small cap. software company. So they have a market cap of just 386 million. So probably not on most people's radar, but you might want to keep it on yours. So ticker is CTLP. And then we're going to wrap it up with a transportation and logistics management company, Hub Group, ticker HUBG. So HUB as in boy, G. And they've been around 50 years, since 1971, so really 51 years. And on the first quarter report in April, they recorded record quarterly revenue, up 41% to 1.3 billion, record quarterly gross margins and earnings, and they raised full year guidance. So they do a lot of this, the transportation logistics that's been big during the pandemic, trucks, intermodal, all of that stuff. And everybody's trying to get things every place, right? So these kinds of companies have done well. It has a market cap of 2.4 billion, so it's not small, and no dividend though with this one. I was kind of surprised. I thought there might be a dividend seeing as it's been around 50 years, but no. 2022 earnings expected to be up 86.7% now that they raised the guidance to 945 from 506 last year. So the guidance was between $9 and $10. So double last year. And 2023, though, analysts a little more pessimistic because of this big surge. But we'll see as it gets closer to 2023, they expect it to be down 21% to 747 there. What are these shares doing? Year to date, down 16.4%. So people thinking the transportation logistics demand is kind of going to dry up, especially if we start to go into a real slowdown, which the Fed is trying to induce the economy to go into, or we have a recession. Then this type of business will get hit pretty hard. So a lot of people, jumping out of this type of company, even though the earnings estimates and everything else looks good. It has a forward P of just 7.6. So it's not expensive here, but it's still in like an uncertain type of industry. People had big gains, and so they're just cashing those in and moving to the sidelines. 1 year, these shares are up 6.2%, but again, that's better than what we've seen with the NASDAQ. That's down 21% over the last year. So it is outperforming the NASDAQ here. So as I said, I stayed away from companies that we've talked about before. I literally just kind of picked random tickers out of this list of 31. I mean, I do know Sanderson Farms, so that was not, unknown. I didn't know what Cantaloupe did. I have seen the ticker floating around, but I didn't know what they did. And I never heard of Hub Group, even though they've been around forever. Just goes to show you that there's a lot of companies that maybe are not on your radar that the Zacks Rank can unveil. That's why I like the Zacks Rank, because it can find these kind of hidden companies that have the rising earnings estimates that I might not have been paying attention to. And remember, nothing is guaranteed. The market dislikes several of these, even with the Zacks #1 rank and that growth style score of A. Those are the top ones. And so they should be outperforming, but we only had 2 out of the 4 of these 4 outperforming the overall market, or the NASDAQ, I should say, because that's what I looked at for this podcast. And so you just don't know for sure. Airbnb, like I said, is trading near its 52-week lows again, and it could go lower. But maybe this is a buying opportunity on some of these #1 ranked stocks, because at least they do have something that the others don't have right now, which is the rising earnings estimates. And that is what we want in this kind of more uncertain economic environment. If a company is managing to grow those earnings, I do want to have it on my list. I do want to see what is developing with it. Obviously, earnings growth can change as economic conditions change. So there's no guarantee with the #1 rank that it will remain a #1 rank. That is a short-term recommendation, only 1 to 3 months, and it can change daily. So this coming earnings season will be interesting for some of these companies, and we'll get further guidance, and we'll see if they're going to hold on to these earnings gains. I'm assuming a company like Hub Group, which only a couple months ago raised their full year guidance. They had to be pretty certain of what that outlook was looking like for the full year. I'd be surprised if someone like them is suddenly cutting it. But the Fed is getting very aggressive with its rate increases here, and that's going to affect the economy. And so we don't know yet how it will impact all of these industries and what is going to happen with earnings for the rest of this year. So far, it's not looking too bad, but we will see going forward. So I'm going to try to run some of these screens as we go through the year here, because the growth side is interesting here. It's a little more dubious than the value, as I've discussed many times on this podcast and the Value Investor podcast. But there could be some hidden opportunities there, and I love those. I know all of you do too. So I'm going to keep looking for those as we go through the year. So let me recap the tickers I talked about. So the education company, I'm not going to say the name of it. It's PRDO. That's the ticker. Airbnb, ABNB. Sanderson Farms, SAFM. S as in Sam, A. F as in Frank. M as in Mary. Cantaloupe, CTLP, and then Hub Group, HUBG. And as always, you want to be sure to subscribe so you don't miss a single episode. I'm bringing you stocks every week, sometimes with guests and sometimes without. But either way, I'm bringing you the stocks. So get us on Apple Podcast. You can get us on SoundCloud. You can get us on Amazon Music and Spotify. But get us somewhere, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.